Hello, my name is Joe Hoyle, talking to you today from the University of Richmond, where I'm on the accounting faculty and I actually do teach financial accounting. In fact, I have a class going right now. We're talking today about how you gather financial accounting information. You could imagine any large company, whether it's Merck Pharmaceuticals or DuPont or the Coca-Cola Company or Procter & Gamble, would have thousands of pieces of information, probably millions of pieces of information. How do you gather that information? In our first video lesson, your roommate has come to you and said, my parents own a business, and they talk about two terms that I have no idea what they mean, and that is the terms debits and credits. In accounting, there are probably no words that are more talked about, no words that are more used than the terms debits and credits. If you're going to take a financial accounting class, it's a great idea to understand what debits and credits mean. In its simplest form, debits and credits simply mean left and right. Debit means the left side of a T account, and credit means the right side of a T account. And a T account is any account that you're attempting to keep a balance on. So if you want to balance off the rent expense, you'll have a T account for rent expense. If you want to keep a balance for inventory, you'll have a T account for inventory. If you want to keep a balance for sales, you'll have a T account for sales. And that T account will have a left side, which is the debit side, and a right side, which is the credit side. Now, many people believe that debits and credits mean increase and decrease. And the answer is sometimes a debit means increase, sometimes a credit means increase. Hundreds of years ago, this system was invented in Italy as a way to help businesses keep up with their financial information. And it has been used pretty much in that same form now for hundreds of years. So when you're looking at a set of T accounts, you'll see things on the left side, you'll see things on the right side. One of those sides will be increase, one of those sides will be decrease. And any person who deals long with financial accounting will just automatically know. It's not like there's a lot of complication here. What I always tell people is, if you have a cost and you want to increase a cost, that's a debit. So what could you have as a cost? An expense can be a cost. You pay rent expense, you pay utilities expense, you pay interest expense. Those are costs. Expenses are cost. That increases with a debit. Another cost is an asset. You buy inventory, that's an asset, that's a cost. You buy equipment, that's an asset, that's a cost. Assets, whether they're inventory, equipment, land, building, whatever, those are all assets and they all increase with a debit. Expenses, debit increase, assets, debit increase. The final cost you can have is a dividend. You pay money to an owner as a share of the profits. That's a cost for a company, and that will increase with a debit. Now, if you've looked carefully at the textbook, I refer to those as the dead accounts. Debits are increases with expense, asset, and dividend. Debits, expense, asset, dividend. I learned that when I was in college. It has worked for me over the years. If you have something that's more of a source instead of a cost, that will increase with a credit. For example, a liability, if you borrow money, that's a source of funds. That will increase with a credit. If you sell something and have a revenue, you sell inventory, you sell a service, you have a revenue. That's a source of assets. That increases with a credit. If your owners put money into the business, that's a source of assets. That's contributed capital. That will increase with a credit. There's only 6 types of accounts that we're going to work with to begin with. Expenses, assets, and dividends will increase with a debit. Liabilities, revenues, contributed capital will increase with a credit. The cost increase with a debit. The sources increase with a credit. That system has been used by millions of business people for hundreds of years as a simplistic way, I sometimes call it a shorthand way, of keeping up with their financial transactions. And if you're going to own a business, if you're going to be involved heavily with the business, if you're going to be involved with the record keeping of a business, understanding that debits is left and credits are right on a T account, and understanding that expenses, assets, and dividends increase with a debit, and liabilities, revenues, and contributed capital increase with a credit, will go a long way to help you see how companies accumulate the information that they gather so that they can eventually make financial statements and give those financial statements to decision makers so they can see the financial health and future prospects of that business. Debits and credits, probably the two most commonly used terms when you're talking about financial accounting. I'm Joe Hoyle. I'm here at the University of Richmond. It's almost time to go teach my financial accounting class. Have a great day. Take care.